Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to U.S. Markets Wrap with me, Ryan Huang. Let's take a look at the latest session on Wall Street, where things are slightly lower. The S&P 500 lost 0.3%, closing at 6,022, snapping a three-day winning streak. The Nasdaq Composite was down 0.5% to 19,616, and the Dow Jones Industrial Average pretty much flat. So this comes as traders weigh a preliminary U.S.-China trade agreement and new inflation data. We'll get into all that with some help from Nadine Terman. She is the CEO and CIO at Solstein Capital. Nadine, thanks for joining us on the show. How have you been doing?
Good, Ryan. How are you?
I'm doing great as well. Markets have been having a lot to grapple with these days with the back and forth on the trade front and all the tariff talks. So let's talk about what's happening on that front first, with U.S. and Chinese officials apparently reaching a consensus of sorts. That would suggest, I would imagine, some good news or relief for investors, but it's not playing out that way when we are looking at the latest session. What's your takeaways here?
Sure. Well, they agreed on the outlines of a plan, so that's really important to state, and it's to restart the flow of the sensitive goods, meaning China will speed up rare earth metal shipments to the U.S., and the U.S. will ease some export controls. But it's not that much of a deal. They are also, giving another, call it 30-day window to get details done. So markets were a little bit more interested in the inflation numbers that were, not as bad as maybe had feared, but core CPI was 2.8% versus 2.9%, which is pretty much expected. People, I think I would say, are waiting for the June number, so this one wasn't that important. So I think there's still fear around June's inflation number rising. There's still fears about global challenges with U.S. and Iran. So people looked at this structure of a deal with China and inflation numbers and decided, I think, to take a little bit of risk off the table today.
Yeah, talking about the risk appetite, or at least how investors are digesting some of the latest data points. What is the mood right now when it comes to trade sentiment with all the uncertainty out there? Are you seeing any, confidence returning to markets right now as we get these deals being done?
There's a great chart from Bloomberg that showed the Trade Policy Uncertainty Index. It's a daily index, and uncertainty is still near an all-time high, Ryan. So, you've got basically investors concerned about trade deals. There's a little bit of structure in place, but uncertainty is at an all-time high. And what does that affect? It affects companies' capital spend plans. So outside of AI, we'll put that to the side, you've got labor plans, pricing plans, inventory plans, and you probably heard Jamie Dimon of JP Morgan today talking about the U.S. economy potentially deteriorating soon. And this is a guy who sees a lot of data related to the health of the U.S. consumer and the U.S. business. So I think folks took note there and said, okay, maybe not everything is going that swimmingly. And a lot of these numbers that they're taking a look at are backward-looking, not forward-looking. And CEOs are still confused about what to do.
Yeah, talking about confusion of what to do. We did get some commentary in the latest earnings season. The outlook projections, the forecasts have all been more measured. What's the expectations going forward in terms of the hiring, the budgeting, and where things are going in terms of spending?
I think you saw a lot of companies. It was interesting. They didn't get penalized here in the U.S. for doing a few things. One, you saw some companies give two outlooks. There's, the rosy outlook, and then there's the less rosy outlook. So that was the first really interesting dynamic that we saw on a consistent basis. And the other one is companies just pulling guidance, right? Saying, it's too hard. Math is too hard, uncertainty is too hard, so I'm not going to give it to you, right? And they didn't really get penalized. So once you saw some big companies do that, they did not get penalized. What the folks that really got penalized this earnings season is when there was so much expectations going into numbers, and then they couldn't confirm those numbers going forward. So it was basically expectations were just way over reality. That's when they got punished. And the folks that actually maybe didn't have a great quarter, but the expectations weren't very high, you saw a lot of those stocks just really rally. So it's a lot about expectations, uncertainty, And folks are giving management teams a little bit time here to not pick a route, but we're going to be at second quarter here soon. We're going to be heading into July, and they're going to have to be starting to give numbers out.
Yeah, perhaps an exercise of expectation management in the latest quarter. All right, let's take a look at what's been playing out as well with the concerns around the U.S. deficit, the debt that's been on the table and rising. How much of a concern is this right now for investors when you look at how yields are going up or the talk about the bills starting to add more pressure on the U.S. economy? Where are we right now when it comes to how markets are pricing in?
Well, the budget here in the U.S., budget deficit, I should say, hit $316 billion in May, with the annual shortfall up 14% year over year. So the U.S.'s financing costs are very high, and that's really why, at least in my opinion, the president wants our rates down. But it's a chicken and egg situation. So even if he were able to affect the Fed, which he can't now, it seems with Powell that maybe he could find someone else to put in his place soon, right? That would increase inflation, which is going to make it very hard to keep lowering rates. So you have a hard time balancing this huge deficit. That's why I think a lot of people are excited when he came into the administration that they would cut costs. But obviously the costs aren't getting cut as much as people had hoped. Tariff numbers are coming down. You know, the growth is slowing a bit here. And interest on this $36.2 trillion debt topped $92 billion. So it certainly is the concern here. You saw Moody's downgrade us, and that will continue to go forward unless they can find a way to cut costs and not increase these expenses so much.
Something that's going to be part of the equation is where oil prices are going, so that could feed into the inflation picture. And they have been doing pretty okay, looking at the latest week, up some 9% when it comes to WTI. For the month, up some 11%. What is the outlook for oil right now?
Well, you saw a lot of banks come out and not be in favor of energy. So you see a lot of people, a lot of investors underweight energy in their portfolios. But guess what happens when there's escalating U.S.-Iran tensions? Oil is up more than 4% today, right? So a nuclear deal seems unlikely. So it's inflationary when oil prices are up. There's a lot more, confusion about what could happen in the future. So I think what you will see is kind of twofold, right? It was okay, I think, for businesses, so airlines and other type of businesses where it's an input when energy was low, but then for consumers who might be looking to travel this summer. But if oil is going to be heading up based on geopolitical concerns, that's a problem. That's inflationary. So that's another reason why, hey, it's going to be hard to get rates down if you have these inflationary tensions. So all of these things are really a puzzle. You can't take one piece and say it's independent. They all are going to affect each other, which is going to affect the second half of the year in terms of what happens here in the U.S. markets.
All right, Nadine, talking about the second half of the year, how are you approaching markets right now with all you've covered so far? We've had May come and go. We didn't get sell in May and go away. Is this going to be a new playbook for the second half of the year?
Well, it's interesting. We're right now in some ways a Goldilocks type market situation, but that can change, right? And another interesting piece of data that happened, and I was just talking with a client because we had a significant portion of his portfolio in gold. Today, gold became like a reserve asset only behind the dollar and moved ahead of the euro when you're looking at what countries have been putting their capital into. And so I think that you have to be very careful about where you're positioned. Obviously, when you've seen huge run-ups in positions, you should be thinking about trimming, exiting, protecting that, however you risk manage. So the plays that happened in the last 6 months, other than maybe I would say a depreciating dollar, which I think could have more of a secular run here, I think you have to be careful of continuing to play the same game because once everybody is in the same trade as you, that's where risk happens. So you want to be thinking, well, where isn't the puck? Well, people have thrown out healthcare, people have thrown out energy, so you might want to be looking into international markets, maybe where people have focused less on in industries that have been not participating in the same way that perhaps technology communications and other industries have had, and really think through your portfolio that way. It's not just a fundamental game, but it's a relative value game. Where is the capital going to flow?
Yeah, right now it seems to be flowing quite a fair bit into gold and other commodities. 28% year to date. For comparison, S&P 500 up 2.4%. So perhaps a bit of diversification is in order. All right.
Well, that's right. So you need to be thinking about that. Is diversification. It's not just whether you're buying the U.S. market in equities or not, or equities versus bonds. You're thinking about asset classes. You're thinking about international. You're thinking about currencies. So it really helps to have a bit of a macro approach before you look into fundamentals.
All right, looking to have you back on the show. Lots to unpack as we head towards the next few months. We've been in conversation with Nadine Terman. She's the CEO and CIO for Solstein Capital. Nadine, thanks as always for your insights. Great chatting with you.
Great speaking with you, Ryan.
All right, stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.